Greetings. This is Ted Hicks, founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Friday, October 1st, 2021. So it's time for our latest monthly market monologue. This is for the month ending September 30, 2021. So before we go into any details, we want to make sure that we put up the disclosure to remind everybody that nothing we talk about on the video today is going to be recommendations. You should obviously chat with a financial advisor or tax advisor if you want to make any changes. Naturally, if you don't have a financial or tax advisor or both, then feel free to reach out to us. My contact information is on the screen. The website is on the screen. Feel free to reach out to us. That is certainly what we do, and we would be happy to serve you. So again, everything that we talk about is just for informational purposes only. I do believe we'll talk about an individual stock or an individual ETF or sector. Again, not a recommendation. So that said, let's dive in to this month's monthly market monologue. So last month, one of the things we talked about was the advanced decline line and how that relates to the S&P 500. So as a reminder, the S&P 500 is the 500 largest stocks in the United States as measured by Standard & Poor's. And you see that is graphed on the bottom pane. That's the green line. That's the S&P 500. The top line is the advanced decline line. The advanced decline line is the cumulative total of the number of stocks on the New York Stock Exchange, is what I've got this up here as. It's a cumulative total of stocks that are advancing subtracted by the number of stocks that are declining. So if there's a negative slope to the line, what that means is there are more stocks on the New York Stock Exchange that are declining than there are advancing. And one of the things we talked about last month is what we call a bearish divergence, that the S&P 500 is going up still, but the number of stocks that are going up is going down. So that's a bearish divergence. Well, this black line here is the month of August. And so that's where the data stopped for last month's video. And you can see what happened. The advanced decline line still continued to go down. And now the S&P 500 has turned over, and that has also started to come down. That's why we watch for bearish divergences. Doesn't mean anything's definitely going to happen, but that did play out like we thought it might. And this is one of the stocks that we have been looking at as an example, because in the S&P 500, the reason why the S&P 500 is continuing to advance is because it's cap weighted. So the largest stocks in that index have a heavier contribution to the math in terms of how the S&P 500 performs as an overall index. Apple is one of those trillion-dollar companies. It's just an easy example. Again, not a recommendation to buy or sell Apple, but this is just what we're trying to point out, that as that index advances, if some of those, what we'll call mega caps, if they start to deteriorate, we would expect the S&P 500 to deteriorate as well. And so you can see early September 7th, we had a high in Apple, and it has since come down approximately 10%. So again, if those bigger stocks that are in the S&P 500, those are the ones that have been propping up the index. If they start breaking down, then we would expect the index overall to break down as well. And here's a broader way to look at that. This is MGC, which is a Vanguard Mega Cap ETF. Again, not a recommendation to buy or sell this. It's just an example of what we're talking about. So the larger stocks, the mega caps, the big companies, again, since that September 2nd high, have come down about 5%. Now, again, that's the difference in the diversification, where you have one stock that's down about 10, but the mega caps as a sector, it's not down as bad. So let's look at the overall month of September. This is what it looked like. It was not a good month. So on the screen, we've got the Dow Jones Industrial Average was down about 2.7% for the month. IWM is a proxy for the small cap sector. So that sector was down, or small caps again are smaller companies. So that sector was down about 3% for the month. DWC is the Wilshire 5000 stock market index. Over the years, we've argued that that's a better indication or a better index for us to monitor, because when you only monitor the S&P 500 and the S&P 500 appears to be going up like it has been, we have a tendency to think, well, all is well. Well, that's not true. That's why we've sometimes we'll look at the Wilshire 5000. That index was down 4.5. In this case, you see the S&P 500 down about 4.7% for the month of September, and the NASDAQ index about down 5.3% for the month of September. So put me in the camp of those that say, thank God September is done. So broadening it out a little bit further, this is one of the Chinese indexes. This is the Hang Seng Index. This is a Hang Seng ETF. You can see a high of February 17 and 18. Since then, that index is down or has come down about 23%. It's starting to rebound a little bit, but 20% is typically when most in the industry would call that a bear market. So the Chinese market, we could argue, has been in a bear market since February. Moving on, one of the things we've been looking at lately is, or highlighting in some of these videos, is the percentage of stocks that are above their 200-day average. To go back and use the Chinese Hang Seng Index as an example, this red line is the 200-day moving average. So the way that a moving average works is it's, again, a 200-day average, so it's calculating the latest 200-day data. So as we have more data for today, 201 days ago is going to drop off that average. So the average will either go up or go down based upon how that math is worked. The way that I run these numbers is these are exponentially weighted. So the most recent day has more of a weight than the day 200 days ago. We want recent history to us is more important than what happened 200 days ago. 200 days are 200 trading days. So in the stock market, that's about 9.5 months. And generally speaking, when a stock or an ETF is trading below the 200-day average, we would say that it is in a downtrend. And you can see this is actually a very good example where the Chinese Hang Seng Index came down, and it kind of moved sideways for a number of months, and then it broke down even further, and it's now down below this 200-day line. We would say that is in a negative trend. It's going down. So when we look at the S&P 500, how many of those 500 stocks are above the 200-day average? And you can see as of yesterday's close, about 60, almost 61% of the NASDAQ is above the 200-day line. Another way to say that is approximately 40% of the S&P 500 is in a negative trend. Now again, that's in the S&P 500. And when we look at the NASDAQ has approximately 2,000 stocks in it, I believe, and that data is a bit worse. So this is January 22nd of this year. Looks like the high might have been January 25th, and ever since then, in the NASDAQ, which has about 4 times as many stocks, those stocks are breaking down, and right now only about 31% of the NASDAQ stocks are above the 200-day average. So in other words, approximately 70% of the NASDAQ is in a negative trend. That is not a healthy stock market. So moving on, we've gotten over the last year more and more clients asking us about Bitcoin. Again, this is not a recommendation to buy nor sell, but I thought I would show this. This is the New York Stock Exchange Bitcoin Index, and I've got 2021 on the screen right now. And what I'm showing is earlier this year that Bitcoin index was up more than 100%. Lately, it's down about 34%. So one of the concerns that we have in relation to Bitcoin is it's pretty volatile. So that's, again, neither here nor there, but that's just an indication of what is going on with Bitcoin, if you will. There are a lot of people that would say Bitcoin is going to be the new inflation hedge. Historically, gold is an inflation hedge, so that when people are concerned about the stock market or are concerned about a recession, you would see gold prices traditionally rise. Well, there's a lot of folks who would say that's Bitcoin. That's how Bitcoin is going to be operating. It's going to be the inflation hedge. Well, as there's a lot of concerns in the economy right now, what we're seeing, Bitcoin's actually down. So I would contend that that's not an inflation hedge right now. So the jury is still out, in my opinion, on Bitcoin. But again, we won't go any further on that for now. Next few slides are just a couple of ways that I look at the overall market. This is what I call style boxes. And so what I want to focus the attention on is this 1 month column. And you can see every single one of these has got a negative number. Europe had the worst month out of this particular list, but all of those figures are negative. Here again, this is our sectors, so the sectors of the S&P 500. So there's 11 sectors of the S&P 500. You had one sector that was positive. Okay, one sector is energy, was positive for the month of September. Everything else was negative. And then when we look at single country ETFs, so the worst performer out of this list, this is not an all-inclusive list. The worst performer was Brazil, down 12% for the month of Brazil. And you can just go down this list and see how many were negative. Obviously, there are some positive. Who is this? Russia. So if you're invested in Russia, you actually had a positive month. Japan had a positive month. Indonesia had a positive month. So that's just showing you what's going on in the rest of the world. There's still a lot of negative numbers out there. So this is the S&P 500 again on the top pane. And I've got what is referred to as a chandelier stop. That's the red and the blue line. So effectively, the way that this works is if the price goes below the chandelier stop, the argument is if you use this signal, that's when you would sell. What I'm showing this for right now is just it's below the line a fair amount lately. That's not a good sign. This is something referred to as the ADX, or the advanced decline line. The fact that the black line is going up while the red line is, which is negative momentum, that's as high as it is. That's also not a good sign for the near term. It's not a long-term projection by any stretch of the imagination. This is VIX. The VIX is commonly referred to as the fear index. So as the VIX spikes, that's an indication that fear is rising. So you can see that the VIX spiked in March of 2020. That doesn't surprise any of you because there was a lot of fear going on right then. What's happening? Well, if you overlay this with the S&P 500, that's the same time the S&P 500 is coming down pretty heavy. So when VIX spikes, it's a warning there. So VIX has been rising a little bit recently, but when you relate it to what was happening in March of 2020, it's not that high. We can go out further into history and see that we're kind of, I would argue, right in the realm of where we are normally. Maybe it's a little elevated, but nothing that I'm overly concerned about right now. But it is definitely rising. Dr. Copper. This is the price of copper, and the gray bars are in the recessionary periods as defined by the National Bureau of Economic Research. So this is the 2001 recession. This is the 2007 and 8 global financial crisis, or GFC as we will abbreviate it. And this is the current crisis, if you will, which according to the National Bureau of Economic Research, that crisis is over as of May of this year, or June of this year. Copper is sometimes referred to as Dr. Copper because it allegedly does such a good job of predicting recessions. And you can see on this line where the recession is going, or the price of copper is going down. Well, look, there's a recession. Here you see the price of copper is coming down. Look, there's a recession. It's obviously not perfect because obviously copper came down here. There was no recession in this period. So this is definitely not a perfect indicator. But again, we'll call attention to the fact that copper is indeed coming down. There's a lot there, and again, that's not the purpose of our video today, but just something that we're looking at. We'll begin to land the plane here. This is our what we call the vertical speed indicator. This is a compilation of 14 different technical indicators that I look at on a regular basis, and I put them all into one so that we can use what we refer to as the weight of the evidence. Right now, our VSI, we are down at the beginning of today. So as of the month end, we're down to 50%. So what that's telling me is half of my signals are saying sell, half of them are saying buy. So doesn't necessarily mean anything, because one of the things that we are also going to look at, we'll come back to that one in a minute, but we'll look at seasonality. This chart here shows us since 1950, so 1950 through today, how has the S&P 500 done by month? And so we can see that September is historically the worst month out of the 12 months during this time period. This is the average month of September. This dot is where we ended up. So it was far worse month than it is historically. That's the bad news. The good news is historically, October, November, and December tend to be good months. We'll see if that happens, but it is the best time of the stock market year. So a couple other thoughts. Right now there's debates in Congress going on about lots of different things, raising debt ceilings, infrastructure bill. There's another one that's going on. I can't remember what they're talking about, that one. But one of the things that, trying to put politics aside and just looking at the data, this is something that I find interesting. There's a couple different data points on here. This data goes all the way back to 1929. And so again, the gray bars are the official recessionary periods. This green line is actually the top marginal tax bracket. And so we're going to use the left-hand scale to tell us what that figure is. So right now, the top income tax bracket is actually 37%. That's what that's telling us. Historically, believe it or not, the highest tax bracket in U.S. history was 95% back in 1945. So that's the green line. The black line is the revenue that the government receives as a percentage of GDP, okay? And then the red line is a moving average. I can't remember what the moving average is. I think it's 12-period moving average. Yeah, so I got a 12-period moving average, so it's about a 12-year average. And so what I'm trying to show here is that once we get enough data in the system or in our records or in the database, so to speak, you can see the red line and the black line it kind of levels out despite what's happening with tax rates. So the argument here is that on average, the government collects about 16% of GDP in tax revenue, regardless of what tax rates are. So there's a larger debate that we could have there and what that actually means. But frequently when we're talking about raising taxes, we talk about raising revenue to the government. Well, the argument here is it may not work because on average, it's going to be about 16% of GDP. So anyway, we can elaborate that further perhaps in another time. But that is something that I've been looking at. This is the total federal debt as it relates to as a percentage of GDP. I think I put this up in last month's video as well, and this is one of our biggest concerns. Historically, if you do your studies on the U.S. History and economic history in the United States, historically we have created debt as a nation to pay for some crisis or another, frequently wars. You could argue that some of what we're doing right now is fighting the war on COVID. You could certainly argue that. But historically, what we have done as a nation is we pay that debt down. There's only been a brief period in our history where we actually had no debt. I think it was in the early 1800s, but the data doesn't go all the way back that far. On the screen right now, you can see in 1980, we were at about 30% debt to GDP. Now, again, the analogy here is this is what, as a financial planner, we would consider bad debt because it's unsecured. If you have a mortgage on your house, some would argue that's quote unquote good debt because if you default on your debt, it's got a security attached to the house. And so if you default, the bank takes the house. Well, unsecured debt is just debt that you might take based upon your good credit history. So a credit card is what we call bad debt or unsecured debt. It's your ability to pay that back is just based upon your income. Well, that's government debt. Government debt is not tied to any particular security or property. It is merely based upon the United States government's ability to pay. Well, as that debt has risen over the years, it's The concern is it's going to become a bigger and bigger problem. And again, longer debate that we could have on this, but we're already at about 20 minutes on this. I would just say this. This is a very big concern of ours. And this is a bipartisan comment, by the way. Okay, because again, this is back when Reagan was in office, and he did increase the debt and increase spending. You could argue he was fighting the Cold War. Good news is you would argue that we won the Cold War, but succeeding presidents didn't pay down that debt. And overall, it's just gotten worse and worse and worse. And now we're at 125% of GDP. So the analogy again is if you have $100,000 in income, how would you feel if you had $125,000 in credit card debt? Not counting your mortgage debt, but credit card debt. Most people would be pretty anxious about that. Now, again, there's some differences with the federal government because they have the ability to raise taxes and things of that nature. I get that. That's beyond the scope of this video, but this is a very high and very scary scenario because of what it could very well mean as we move forward. And as we have talked about last time, and I will probably continue to bring this up, this is the concern that we have. This is not an average stock market return. This is actual stock market history. This is the United States S&P 500 from 1965 through 1979. So it's a 15-year time period where the stock market in the United States was very violent. It was up and down a lot. There's 4 bear markets during that time period. So most of us, that's what we're used to. The last 15 years, yes, we had a pretty bad market in 2008, and we had a pretty big scare last year. But in general, there's been a large trajectory, and it's been upward sloping. But that's not always the case. And so if you are 50, for example, and watching this, well, what would it look like if the next 15 years between now and when you're planning to retire, what if it looked like this? How do we navigate an environment like that? So again, not trying to be prophetic, but that is something that scares us when we have as many economic concerns as we have. Doesn't mean that you can't necessarily take anything from that. It's just something that is a very big concern of ours. So I hope that helps. We'll throw the disclosure back up. Again, our contact information is on the screen. If you find this helpful, feel free to share it with others. If you have a question on that, feel free to, a question on anything that I talked about in this video, feel free to shoot me an email, and I'm happy to chat. And again, we'll do another one of these at the end of October, where hopefully we'll have better news now that we're into that 4th quarter. So until next time, thanks for watching, and we'll talk to you next time.